Good morning, everyone. Welcome to this TradeStation Masterclass. My name is Jesus Nava. I'm the Director of Client Training and Education for TradeStation Securities. It's always great to have you all here to learn about the TradeStation technology and maybe some trading strategies. Today, the focus is going to be on futures spreads and one of the platforms that TradeStation provides that we call FuturesPlus. Sometimes, this topic gets confusing to some clients because of the way that it's set up and the fact that you have to open up a separate account in order to trade future spreads. But if you have any questions about the process, please feel free to send any questions right here into the chat, and I'll be standing by just to take your questions, and I'll answer them on the chat as to provide you information on how the process works. But this topic on future spreads is part of a series that we're going to do this year. It's a 6-part series, and this is lesson number 1. The 6th part is broken into 2 separate sections. One is dedicated to futures spreads, and then we're going to do 3 final sessions on futures options. But the 6-part series is a masterclass on FuturesPlus and how you can trade these products that are specifically available on FuturesPlus. I'm going to pass the microphone over to Brandon in just a moment. You see that I'm joined by him. I just need to go through some of the disclosures and some of the introductory information, but I want to tell you that if you go to the events page right here at TradeStation.com, once you land on the homepage, just go to Learn and then click Events. You're going to find towards the bottom of this list of events that we have, lesson number 2, scheduled for April 22nd. And then we have the remaining 4 sessions right here at the bottom. We go all the way until August. So if you like the content of this session and you'd like to follow up on the subsequent sessions, please make sure that you register on these as well. And that way you get the full experience on this series. All right. A few disclosures before we get started. Just keep in mind that every symbol and idea that we talk about is for educational purposes only, that these are not recommendations of TradeStation. Also, that active trading is not suitable for everyone, and past historical performance is no guarantee of future results. One thing that I need to point out also is that Brandon, even though it's a pleasure to have him, and we get the privilege of benefiting from his expertise, he is not affiliated with TradeStation, so his ideas and presentations, of course, are his own. But thank you guys for being here. If you need additional information on these disclosures, just go to tradestation.com/important-information. All right, enough of introductions. I'm just going to go ahead and pass the microphone over to Brandon. Brandon, the floor is all yours, my friend.
Great. Thank you very much for having me. I'll go ahead and send you the request for sharing. There we go. And now you should be able to see my desktop. So welcome, everyone. And thank you for having me. Appreciate it, as always. And basically, quick background on me, who I am, if you care. I am a chartered market technician, which basically means I've got a kind of a master's degree in technical analysis. I had to learn a lot of different types of trading and technical analysis to analyze all the markets. And I share that in my classes that I teach. I am a trader full-time in futures and options. And I also do more advanced type of futures trading, which we're going to discuss today, which is futures spread trading. I basically got involved in the markets as a retail broker and moved into back office operations. And I was a trader for the brokerage, basically what they call agency desk operator. Ended up becoming a private trader for myself because, well, less stress. But I went back to work with a mentor and gain more education. And eventually I was hanging around there so much, I ended up becoming a teacher, assistant, and worked my way up as I was profitable in my trading to become a full-time instructor and full-time trader. So that's what I do now. I'm actually, again, I mentor traders and help them along their journey, just as someone did for me. And well, that's pretty much it. So we're going to jump into future spread trading. Let's see here. And basically, we're going to talk about what the heck it is. And I want to get one thing clear. This has nothing to do with options. A lot of people talk about spreads and their immediate thought is options. buying calls and puts and doing combinations, multi-leg option strategies. No, that has nothing to do with what we're doing today. Today, we are dealing only with futures and not even futures options, just the futures contracts themselves. So we'll talk about the different types of future spreads, what they are, and how they vary compared to trading option spreads, which, an option spread is the same thing. It's buying and selling related contracts. And that's all we're going to be doing when it comes to future spreads is buying and selling related futures contracts. We'll talk about how the quotes work, how the charting works, and we're going to be using TradeStation Futures Plus for the platform to be able to execute the trade ideas. And basically, we'll talk a little bit more about some of the other details of it, how you can use these as a directional trading substitute to kind of minimize the risk. Now, anytime you minimize risk, you're also going to minimize reward. So you got to keep in mind those go hand in hand. So we'll jump right into it. Of course, you have any questions, if they're on what we're talking about, I'd be more than happy to answer them. If they're a little bit off topic, I'll try to answer them at the end. I'll open up for a Q&A session here. So basically, what is a future spread? Well, I hinted at it already. A future spread is simply buying one contract while simultaneously selling a related contract. And related is the key word there. They have to be related either by being the same security with different months, such as crude oil May versus crude oil July, or they could be equity indexes, NASDAQ versus Dow. Those are related. So you're going to buy one and sell one at the same time. You're long and short. And this can be done as a single transaction. Basically, you put both those orders in together as a spread, and that's the way it does. It works, on TradeStation's Futures Plus. I'll show you that. Sometimes you have to do it legging in, which is not as good because then you have to worry about different spreads between bids and asks, and you have to pay extra commissions. So if at all possible, you want the advantage of putting it all in at one order. So we're doing this because we're not trying to profit from an upward or downward move in the individual securities. We're trying to profit based on the relationship between the two securities. The price difference between the two either widens or narrows. Even if they're both moving up or down, they don't always move at the same pace. And that's what a spread does. It's trying to take advantage of the mispricing between two related securities. And because what happens typically, if the mispricing occurs, we have what is called reversion to the mean. And the reversion to the mean simply is when prices or anything moves away from the average, it typically tries to revert back to the average relatively quickly. And that's what we're trying to take advantage of is the move away from the average or that move back towards the average. And we can trade both, and I'll show you how it works. So basically, what is a future spread? Well, here I got December 2024 corn, and it's just a single chart. Okay, well, if you take a look at a related contract, March 2025 corn, they're both corn contracts, right? They're trading the exact same thing. It's corn. The only difference between the two is the fact that the months of expiration are off by 3 months. December expires quicker than March, obviously. And what you'll notice is that they are not the exact same price. Okay, this is actually done on a percent change chart in this case. And you can see that they were together, but they separated. As they were moving down, the December corn actually dropped in value further and faster than the March corn did, percentage-wise. There's about 2% difference in price. So a spread is simply the white space between those two lines. That's all it is. And you can see sometimes it gets wider, sometimes it gets closer, narrower. And we trade that, the price difference between the two. The nice thing about future spread trading is it doesn't matter what the overall trend is for the individual securities. It could be uptrend or downtrend. Corn could be going up or down. It doesn't matter. What matters for our purposes is how are they moving in relationship to each other? Is one moving faster than the other in the downward direction, or is one moving faster than the other in the upward direction? So that's what a spread does. The spread is the price difference between two related securities. That's all it is, that white space between the two. And we trade that. So you could have this same underlying security. You saw corn versus corn, or I mentioned crude oil versus crude oil. You could do NASDAQ versus NASDAQ, but you just choose separate months. Or they could be related securities, meaning they might be in the same industry, or not industry, but same sector, if you will. So gold versus silver, those are both precious metals. Those are related. And they have a relationship that they normally maintain between the pricing of each of those securities. However, for whatever reason, sometimes the prices go away from their norm and they're likely to snap back or revert to the mean. So as an example, let's say our first security is at $54.35 and the second contract, the second security is at $53.17. The spread is $1.18, simply the price difference between the two. That's all. Nothing more, nothing less. Now, if they both move up, but the first security moves up further and faster, that moved up to 55.16. So it gained more than the other security that only went up to 53.85. If you subtract, the difference between those now is $1.31. So the spread, we say, widened from $1.18 to $1.31. That's all. The price difference between those two securities. Again, pretty simple, right? Now, simple doesn't necessarily mean easy. It does take some time to practice this and get used to it. The nice thing is you can actually trade in a simulated mode if you want to in TradeStation FuturesPlus to practice futures spread trading, which is very, very beneficial because you don't have the emotions, you don't have the money loss, and you get to practice. Now, you don't get the money gains either, but you get that opportunity. So a widening of a spread, remember there's two directions spreads can really go. They can go widening or they can go narrow or narrowing, widening or narrowing. So the widening is basically when the price difference between the two expands. So if we have price number one at 21.46, price two, 21.22, the difference between them is 24 points. If they move up, and the first one moved up almost 20 points, not quite, okay, to 21.61. The second one moved up as well, but not nearly as high, only 8 points. You notice that difference between them went from 24 to 31. Even though they both went up, one moved faster than the other. That's the spread widening, as I said. The narrowing would be just the opposite if they're coming together. And that can happen in a bull market or bear market if the one moves faster than the other. Price number one, 143, price number two, 118. The difference is 25 points. Well, price number one moved up 5 points. Price number two moved up more, 11 points. So the spread narrowed from 25 down to 19, even though they both moved up. One moved faster than the other, price number two. So that's what we were taking advantage of when it comes to spreads. Simply trading the price difference between two related securities. And that's what it looks like on a chart. If you have the chart of one security, price number one versus price two, widening when they get further apart, narrowing when they get closer together, widening, narrowing. And it can happen in either direction, up or down, or even if things are trading sideways in a channel, you can still get widening and narrowing of a spread. So there's still opportunities. Now, we have different types of spreads. The one that many people start with or trade, is pretty common actually, is called an intramarket spread. An intramarket spread is where you're buying a futures contract and selling a futures contract on the same underlying security. So as I said before, it could be both NASDAQ, could be both Dow, whatever. They just have different months. And basically what we're looking at here could be crude oil. And that one I use December 24 versus January 25, NASDAQ December 24 versus March 25, and so on. So there's two types of intramarket spreads. When you take a look at contracts, there are multiple contracts available. For instance, in the NASDAQ, there's about 5 contracts available at any time. You have what they call the front month, which is the one that has the most volume, and it's usually expiring next. It's the one that's going to be expiring very soon. In this case today, the NASDAQ would be the June contract. June 2025 is the front month. Okay, we can actually go out. Let me see here. I go out to CME Group and under markets, NASDAQ, just to show you, under quotes, there they are. June, 228,000 contracts so far today. September, 256 contracts, but there are other contracts still available. Actually, it's more than 5 now. They expanded, but nobody's really trading them. The front month is the one with the most volume. Now, keep in mind, it's not always the one that's expiring next. I said it's the one with the most volume. It's usually the one that's expiring next, but it isn't always. Okay, so again, if I go back to markets, let's go to corn. Again, going to quotes, physical commodities usually have more contracts available than indexes. So here with corn, we see, yep, the next one is May, and oops, that has the most volume. And there's actually a lot of volume. Notice it skips September. The volume is not very high, and then it goes to December in comparison. So again, it's not always the one that expires next. It's whatever has the most volume is your front month. Everything else are called the back or far months. Okay, this is called the front or near month, the one with the most volume. And you just trade one against the other. You'll notice when you look at the prices, the changes today, they're not all the same, are they? The May contract is down 6 points. Meanwhile, we're down 5 3/4 on the July. We're only down 3 points on the September and only 2 1/4 on the December. So while they're all moving in the same direction, they do not move at the same pace. That's where the spread comes into play. We can take advantage of that. So what are we talking about with bull spread and bear spread? Basically, we're substituting a spread for an individual directional trade. That's what we can do. Because what happens with a bull spread, the front month has all the volume, right? And because it has the most volume, it usually moves the furthest and fastest in the direction of trend. So if we're in an upward trend for that security, say we're moving up in crude oil, that front month is probably going to be moving the furthest and fastest because it has the most volume and most activity. So what you do is you would buy the front month, and because it doesn't move as fast, you sell short the back month. Now, why would you want to do this? Because the front month, you're going to make money on the long, but you're going to be losing on the back month at the same time because it's also going up. But because it doesn't go up as fast, you don't lose as much as what you are gaining. And the reason why you would do this is the margin requirements are much, much lower, as we'll see. You don't need nearly as much capital to trade a spread as you do to trade directionally. However, you won't make as much. Again, you reduce risk, you reduce reward. But rate of return can still be pretty high, which is pretty nice. So a bull spread, instead of just buying the front month, if the front month moves up faster than the back month, you would profit because you're making money on your long, losing less money on your short at the same time. Bear spread is simply the opposite. You're selling the back month and buying selling the front month, buying the back month. Okay, so it's based on what you're doing with the front month. If you're buying the front month, it's a bull spread. If you're selling the front month, it's a bear spread. So again, this morning, had you shorted the May corn contract, that went down by 6 points. That's $300. It's $50 per point. If you had bought the September contract, that went down 3 points. You would have been losing $150. But since you made 300 and lost 150, your net position, if you entered the bear spread selling May and buying September, you would have had a net 3-point gain or $150. That's how it works. So bull spread, you buy the front month, bear spread, you sell the front month against a back month, and you choose which back month you want. So when it comes to types of spreads, again, oh, what happened here? That's interesting. My title got shifted on me. But again, continuing with the types of spreads, we have what are called intermarket spreads. And basically an intermarket spread, you are going to be buying a contract and then selling a related securities contract, and not the same one, but a different security. They don't even have to be the same months. They can be separate months as well. Okay. So often they are the same months, but not always. So we could do gold versus silver. Perhaps we do the April gold GCJ 25, and we do the May silver SIK 25. Gold and silver have a relationship. They're both precious metals, as I said, and they don't have to have the same months. We can do, as I showed you, crude oil versus heating oil. The raw product versus refined. That's both the same month, February 2025. Or the NASDAQ versus Russell 2000. Or euro versus the British pound. And again, many times they are the same months, but they do not have to be. They could be different months. That's an intermarket spread. Intra, same security underlying. Inter, different underlying securities. So basically with the intermarket spreads, it's a little bit trickier. Intramarket, if you're trading the exact same contract, just different months, the point values and tick values are the exact same. That's easy, isn't it? Right? Crude oil versus crude oil, it's all moving by a penny, which is worth $10. That's the tick value. Point value is 1,000. But if you traded crude oil versus gasoline, now we're looking at something different. Crude oil, again, moves in pennies, $1,000 a point. Gasoline moves in thousands of a penny, I think it is. And they are basically $42,000 per point. So it's totally different. And when we're trading intermarket, we have to make accounts for that. They actually have different values. And basically, there's two values that you'll normally deal with when it comes to futures. The one everyone's pretty familiar with is called market value. Market value is what's shown on the chart. Basically, if I were to look at a chart, and I have bring up a new chart, just do ES, June 2025. And the chart is printing, and right now it's at 58.31. That is the market price for the ES currently, 58.31. Pretty simple. And actually, let's do, there we go, a little bit better. So that's the current price of, or I should say, the current market price for the ES. But we need to do what is called the notional value when we're comparing for hedging and spreads. Notional value is the actual value of the security covered under one contract. So I probably used the wrong example here, but basically the market value times the point value is the notional value. So again, if we go out 58.32 and the ES is $50 a point, one ES contract is worth roughly $291,600. That is the notional value. As an example for a physical contract, let me change this one. CL, crude oil, May 2025, is currently trading at 68.98. If we multiply that by the point value 1,000, you are trading 68,000, we'll call $69,000 worth of crude oil. That's the notional value. One contract right now, the market value is $68.95. The notional value, what you're actually trading is almost $69,000 worth of crude oil. Okay, that's notional value. And when we deal with spreads, we deal with notional values. That way we're comparing apples to apples, not apples to oranges. Again, if I were to take a look at a different security, say gasoline, as I was mentioning earlier, this, by the way, is TradeStation FuturesPlus. If you have never seen it before, it is a TradeStation platform, or it's the platform TradeStation uses for futures options and futures spreads. And as I was saying, with gasoline, we have 2.2085 times the point value of 42,000. That means you're trading $92,000 worth of gasoline when you trade a gasoline contract, or basically what I use to fill up my truck. No, that's not that bad. Anyway, that's notional value. Notional value is the actual value of what you're trading. Market value is what you're buying and selling the contract for. When we're doing charts, we have to deal with notional values in spreads. You don't really worry about in directional trading. You just use the market value. You buy at a market value and you sell at a market value, hopefully higher than what you bought, or you sell at a market value, then buy it lower, hopefully. Obviously, it could go the other way. Let's say we're dealing with the E-mini NASDAQ 100 versus Dow 30, the Dow Jones Industrial Average. So NQ versus YM, right? The NQ has a point value of 20 bucks. At the time I made this slide, it was trading right around a market value of 21,211. That means that one NASDAQ contract represented $424,000 of value. It's basically what you're trading is roughly $425,000 worth of stock. The Dow was trading at 44,882 at the time, and that was at $5 a point or $224,000 for a contract. Now, when you chart these, you don't typically chart them separately. You chart them together in what we call a spread chart. So as you can see, this is being charted as NQ December 24, YM December 24. And if I zoom in a little bit, you can see it. Oh, not there. Hold on. Right here. This was a 5-minute chart of YM, NQ minus YM. So basically what we charted here was the price of the NASDAQ minus the price of the Dow. Again, if I zoom in, you can see if you take 424,220, subtract 224,410, you're getting roughly 199,805. Now, plus or minus again, because it moved while I was taking pictures. But that's all that is. You're charting the physical distance between those two prices. That's all. So we can create this using what we call auto spreader. That's probably the easiest way to do that. And we can create charts from that pretty well. So for instance, if I go into, here is auto spreader that I opened up. It's one of the widgets. So you can go into widgets under automation, auto spreader, and I can bring a new one up if I want to. But basically, with this auto spreader, I just hit create, and let's see, we'll do gold versus silver. How's that? And leg one, I choose a contract, and we're doing GC for gold. There we are. And I can do the front month contract. We're not trading March. We'll go to April. I'll click on that one. And for the contract number 2, SI for silver. And again, I can go out to the front month contract, and I can look up whatever the front month contract is, again, by checking that CME website, going to markets, perhaps gold, and just getting a quote to see which one has the most volume right here. And which one has the most volume? Of course, April. That's why I chose it. And going to another metals product, silver. What was it? Precious. There it is, silver. And again, with the quotes, highest volume. Notice it's not the one that expires next. That's what I mentioned before. Front month is the highest volume. The one that expires next would be March or April, but the front month is May. So that's why I use that. So in my future spreader, notice I did gold, April 25 versus silver, May 25. Ratio, how many contracts do we need? Okay, now this is where it gets a little more advanced. At times, you actually have to know some of the ratios that you're supposed to be trading. You can look them up on the CME website, or if you have a mentor that can help you, they'll let you know. This multiplier we have to change. This is the point value that we're dealing with. And you'll notice the silver is a negative number because we're going long on gold, short on silver, since I put that second. Typically, whenever you're trading a futures spread, whatever contract you're buying goes first. And it's just the way that it's accepted, if you will. So right here, I would type in 100 for the multiplier for gold and negative 5,000, the point value for silver. And I believe, if you go down, you can see the tick information there as well, and deltas, all that good stuff. So if I save this, gold versus silver, it should be saved. I just have to find it now. Is this the one I did? Yep, gold versus silver, local. Because there's other ones that people have created and shared, but there's mine. And I click here, open chart, and I can even do this, open chart with legs in tabs. I'll do that, show you. So basically the first chart that I see, you'll notice there are tabs here at the bottom. And unfortunately it did me a 1 minute chart, which is not really useful, but I'll go to a daily and fix this font so we can see it. Should take a moment. It's loading up right now. You see the little wheel moving there, but that is the actual price of gold times $100 minus the price of silver times 5,000. It's the notional values, and that's a live chart. Again, it's loading up right now. It'll take a few moments because I just switched to a different time frame as well. And if I want to see gold, I click on gold. That's the actual 1 minute gold chart. It's at $3,023 per ounce. Silver, 34.130 right now. That's the market value. But again, if you multiply by the point values, it's this chart. That's the notional value. It's still loading up. Takes a little while, but it'll come up. Okay? So it's pretty simple. You can create those intermarket spreads very, very easily. Intramarket, you can actually use a different tool if you want to. Under widgets, again, I think it's market view spread matrix. So there, if I bring that up, let's say we want to go to nat gas. I type in NG, nat gas spreads. And it should load that up. It might be taking some time because of that other chart still. Let me close out that chart. Speed this up a little. And what it'll do is it'll create a spread chart or matrix that I can use to compare the different contracts, which one I want to buy, which one I want to sell. And I can trade the intramarket spread on nat gas by choosing which one I want to go long, say May versus September. I would short the September. So that'll load up in a moment, hopefully. But that's how you can create the spread charts pretty simply on TradeStation FuturesPlus. There are some videos, by the way, getting started videos that Jesus has made that are very, very good. That'll walk you through a lot of the features on how to use this TradeStation's FuturesPlus. So when it comes to those intra-market spreads, I'm sorry, not intra, inter. Again, the intra is the easy one because pretty much you're dealing with the same point values and same tick values. But intermarket spreads, you have to do what's called delta neutrality because remember, I want to profit from the price difference between the two related securities moving either together or apart, right? But what I don't want to have is a bias to one direction or the other because this future spread profits either from the two moving apart or two moving together. It doesn't need to profit from them both moving up or down. We want to have that neutrality where it doesn't matter if both securities go bullish or bearish. We don't want that affecting the trade. We simply want to try to profit from the relationship between the two. Okay. So, how do we do that? Well, we need to make some adjustments based on volatility and notional values. Unfortunately, that's something you might have to do. Sorry, let me see something here. Yeah. So by doing that, maybe adjusting and buying extras or selling extras, it maintains a delta neutral position in the markets and it mitigates the directional effect, which is pretty cool. Okay. So if you go to the CME group, there's actually a margin page that gives you the correct ratios when you go to the margins. Again, if I go back to the CME group page, scroll up a little bit under, there it is, margins off to the right a little bit here. There it is. What you'll see is you've got outrights. Okay, that's the margin requirements for the single trade. In this case, I'm on silver. So just trading silver, that's the margin. Well, it shows the maintenance requirements. And basically, to figure out the margin for getting in, if you've been traded futures before, you know that the margin is, initial margin is what you need to use to get in. Maintenance margin is what you need to have equity-wise in your position to avoid a margin call. Well, the relationship is pretty simple. You just simply take, and they don't post the the initial margin on this page. There's other ways of finding it, but this is not where it is. The maintenance margin, which is shown here, you simply multiply that by 1.1, and that is going to be your initial margin. Pretty simple. You take the maintenance margin, multiply by 1.1, and that's your initial margin. All right. Now, we don't care about that. We're going to the intra, and right here, you'll see intramarket. These are the spreads. So silver, notice it says ratio 1-to-1, side A and B. One of those is a long, the other one's a short. Doesn't matter which. When it says A and B, it just means that one has to be different from the other. One has to be a long, one has to be a short. In this case, this would be the spread for silver March 2025 versus April 2025. Yeah, we're not trading that right now. The front month is actually May, so I go to that one. Maybe we do May versus June, or June versus July, or July versus August. And there are different spreads being shown here. The maintenance margin is $300. So how do I know my initial margin to get in? Again, just multiply by 1.1. It's pretty simple, right? 300 times 1.1. And I could have done that in my head, obviously, it's $330. That's the intra-market margin. That's a lot lower than what it was for the directional, wasn't it? Outrights overnight margin was $13,000. Intra-market spreads, this is the overnight margin for that. It's only $330. Now, because that margin's so low, you won't make as much, but you have very limited risk. You could actually do future spreads in retirement accounts because the risk is relatively low compared to the directional trading for futures. You can still trade futures in retirement accounts. You can do self-directed IRAs with futures. Now, if we're doing intermarket, I go here to enter, and there's gold versus silver. And what do we have to do for our combo here? Notice delta, it's simply 1-to-1 ratio. And the margin is not being shown. What's being shown is a credit. Whatever the normal margin is, you get credit for 75% of that. But there's actually an easier way to find the margins. And we're going to cover margins in more detail in another video, so I'm not going to get into it right now. Okay. But what I do want to show you is what if we go to a different market, like the NASDAQ? And again, I go to margins to take a look at those. And we go, not outrights, but outright, you can see that's the maintenance margin. Again, we got intramarket margin. So if we want to hold overnight, it's actually pretty cheap to hold these overnight, isn't it? This is the full-size NASDAQ E-mini, which normally you're spending $25,000 to hold overnight. If you do it as a spread, where you're shorting the September, buying the June contract, overnight margin, let's see, 232 times 1.1. It's only $255 to hold it overnight. That's the NASDAQ. That's why this could be used as a surrogate or substitute, actually, for directional trading. You can either go out, and if you think the NASDAQ's going up in value, you buy the NASDAQ future, and you have to worry about the margin requirements. Intraday, it's obviously less, but overnight, you've got about 25 grand you got to use to put down that margin and cover your potential losses. If you buy the September and buy the June and sell the September as a spread, now you only have to come out with $255 to hold overnight. Pretty wild, isn't it? It's a total different animal. Makes it a lot cheaper to be able to trade and opens up a bit more trading for people overnight who might not have been able to do it otherwise or had to trade micros instead. Now, taking a look at the intermarket, this is where it gets interesting. Right here, we have ES versus NQ. And that actually does show the maintenance to get in. And you can see it's simply a 1-to-1 ratio. If you short the NASDAQ and buy the ES, the overnight margin for the spread, 10,557 times 1.1. That's $11,612 to trade that. Now, shorting, it's a little bit different. But again, you just multiply that by 1.1. But let's see if we can find the NASDAQ versus, say, the Russell or even the Dow. Let's see, what are they? Oh, there's the Russell right here. Look at this. That is the NQ versus RTY. Notice the delta ratio is not 1-to-1, is it? For every one NASDAQ contract that we want to trade, we have to do 3 Russells. Why? Because of the volatility and point values of those securities. We have to maintain delta neutrality. If you just did a 1-to-1 ratio, if both of these moved up or down, that would throw you off on your spread trade. You would actually have a bias or towards the bullish side or the bearish side, depending on which. So in order to neutralize this, sometimes you have to take on extra contracts. So if I wanted to create that auto spread or the spread trade again, that's weird, it didn't add the tab. All right, we'll go here to create the spread. And again, I'll do NQ versus RTY. Well, if I create this NQ NASDAQ and show me the June, there it is, NQ June 25. Here I go, RTY June 25. I have to go -3. And of course, I still have to use the point values, $20 per point for the NASDAQ, -50 for the Russell. And I think this is show here as well. It's showing the delta now for these positions. I believe it's already auto adjusting. Let me just make sure. No, it's not. But anyway, I have to do that to balance it out. And now when I save that, it's showing NQRTY, there we go. Open chart. It's going to give me the 1 minute again, of course. But there it is. That is the 1 minute chart for the NASDAQ versus Russell with 1 NASDAQ contract versus 3 Russells. And that's the correct way to chart the spread. And we're going to learn in future videos as well how to actually trade these. But it's going to be very similar. Technical analysis is going to be almost identical to what you do on directional trades. But you have to have the right fundamentals there and the right contracts. So by doing the right delta neutral position, it mitigates the directional effect on the position. It doesn't matter if markets go up or down, you're simply trading the price difference between those two, which is pretty cool. Again, you're reducing your risk and focusing your trading on one specific thing. So you can go to the margins page, as I mentioned, for any security. You go to Inters, and that'll show you the intermarket spreads. And you can actually look for others. I didn't do that, but when I go back to that page that I have open, scrolling up a little bit right here, I can switch. Let's say we go to CBOT, agricultural products, and I can choose, this is on Intermarket, we have corn futures. And here I have corn versus gasoline, or sorry, not gasoline, crude oil. That is a 3-to-1 ratio. We could do actually corn versus gasoline. There's an ethanol trade. I just got to find it. This is Brent, crude. Again, that's pretty similar because you're trading oil, which then gets refined, versus corn. It's kind of an ethanol trade. There it is. That's what I was looking for, though. Corn versus gasoline, literally trading ethanol, because that's the additives that are created to go into the gasoline. And you can see it's a 3-to-1 ratio if you want to trade that. So if there are government changes in requirements for ethanol, where they're reducing the amount required or increasing the amount required, or whatever it may be. Maybe there's some bad crops going on where we didn't get a good crop for corn. Prices between those will change. Relationships will change, and it gives you a chance to trade that. So again, I can go in and create that in my spread. Oops, I was on the right page. Right here, not that page. Again, close this, create, and create a spread. Corn, gas, and just enter those spreads. Okay, there's also, this card changes for now. I believe, that's the auto spreader. I thought there was another one I can actually create or pick ones that are already created by the exchange. And I forget where that is right now, but I'll find it for you later. I might have it in here already. But again, just check the dates in the ratio. Many of these are one-to-one ratios, but based on volatility and point values, they may not be. Here you can see the Russell versus NASDAQ 3-to-1 ratio. So I had to choose 3 contracts versus 1 of the NASDAQ. Or British pound versus euros. That's a 5-to-3 ratio. Totally different, right? So definitely pay attention to the ratios, because otherwise you're going to have a bullish or bearish bias in your spread. And there are actually multiple spread ratios where you have multiple securities. In this case, it's a 4-2-1, live cattle, feeder cattle, and what they're eating, right? So there's a bunch of different spreads out there. And this is not something that's just a little niche thing that nobody trades. This is actually a large part of the professionals trading markets. They do quite a bit of this. It could make up over 20%, 25%, over a quarter of the volume of a particular security. So again, charting the spreads, as I said before, we don't do them separately like this, corn versus corn, or put them together. We simply take the prices of one minus the price of the other and chart the difference between the two. So right there, that was corn 2025, March 25 versus minus December 25. And that's the result. And you saw me when I created some of those charts. And again, we're going to have some more advanced sessions where we'll actually talk about how to identify opportunities and actually trade the opportunities using FuturesPlus. So you can put whatever one you want first. Okay. It doesn't matter. Whichever one you're buying or selling, you can put it first. Typically, you put the long one first, whatever one you're buying. So the first contract, though, that you're putting on your chart is the actual one being charted. So when I go back to my charts that I created right here, for instance, I did corn versus soy. Well, since I had corn first, that is corn minus soy, and that's the value. Or here I have corn meal versus soy oil. Soy meal versus soy oil. Since I put soy meal first, that's the one that's being charted, minus the other security. And when you're using intramarket spreads, okay, where it's the same security, you have to do a little bit of work on the chart, not too much. What happens is the difference between where you're possibly entering and exiting, or in this case, if you're shorting here and stopping out above, that difference has to be multiplied by the point value to get the actual gain or loss that would be experienced. The other way of getting around that is you could simply use notional values, because notional values right here, if we did silver versus gold and charted the notional value, whatever the one price is minus the other, that's the actual dollar difference. So right here, we have the notional values. I did gold 100, silver 5,000. And in this case, if we went from 109,855 down to 109,800, that would be a $55 change. 1 point is $1 on a notional value chart. So again, if I go back to my charts, and let's do this, expand. Don't I have a bigger one? Yeah, there we go. That's better with the size. So this is gasoline. Let's do a spread. Okay, so we'll do RB, future spreads, enter. And let's see, we've got April 2025. No, we want May versus October. Why not? We'll just pick one random here. This is May versus October spreads. What? All right, let's try a different one. Yep, that's what I want to do. Corn, future spreads. And we can do May, September corn spread. There we go. That's May, September corn spread, intramarket, both corn, just different months, right? The problem is if we move from 17 down to 10, that's 7 points. I have to multiply 7 points times the point value to see the difference between the price, which would be $350. Or I could go into that and create the spread chart and make it notional value, basically multiply it by the 50 points. And that way you would actually see the dollar difference there. Okay. Do I ever use a spread chart to read price action or underlying market chart? If I'm trading the spread, I use the spread chart to do my technical analysis. Absolutely. Because the same techniques that I use with trend, supply, and demand, they work here. Absolutely, 100%. If I go in, come on, for instance, we get array right here, got a nice little supply zone where prices had an imbalance and a big drop. Prices came back there again and they dropped. Yeah, I chart the actual spread that I'm trading and do my analysis right on it. But I like to use notional values whenever possible because a dollar move, or sorry, 1 point move on a notional value chart is a $1 gain or loss. So it makes it a little bit simpler. So in this case, you can see I had to multiply by the point values, but because the ratio is different, I also had to take into account I need 3 Russell contracts for every 1 NASDAQ contract. And that would give me the proper chart. So I can open that chart in the auto spreader. And there it is with notional values with the correct weighting. A 1 point move equals a $1 move. Makes it nicer, easier. So it's kind of like stocks. You don't have to worry about, multiplying by anything. If one share moves up by $1, you made $1. Well, notional values work the same way. Point values, you still have to multiply by the points to get the right values. So here, it's easier to calculate risk reward if you use notional value. The risk is the difference between your entry and your stop loss, and the reward is the difference between your entry and target. So if I had a short position where I was going to short at this bottom line and get out if I'm wrong above the upper line, I have this subtraction right there, and that's the actual risk, $1,260. This happens to be on the Russell and NASDAQ 3-to-1 ratio spread. The reward is the difference between where I'm entering and where I'm exiting. Oh yeah, I'm definitely going in more detail on these. This is just an overview of what spreads are all about. We have a session completely full hour on risk management with this and determining those, so don't worry, and risk reward calculations. So again, if you're looking for the spread ratios, again, you can go to the CME group and look at the Intramarket or Intermarket margins and find the ratios that you need for any particular securities. Again, I can go back to my browser, CME website. I'm under margins already, and I have the little tab right here. Let's see, we can go to CME, all asset classes. No, why does it only give me equity indexes? NYMEX, CBOT, try agriculture. I was trying to find, it's weird, it's only giving me a few of these right now. There's another way of finding the margins in addition to this. It's a little more advanced. And again, I'll get into it more detail later, but if you go to the customer center, it's actually, they've replaced, you have to create an ID and log in. It's free to create the ID though. CME customer center, and margin calculator. And here, again, I'll go into more detail with this in the future, but let's say I want to do what we're looking at here. Live cattle, actually live versus feeder. This is what they replaced. The easy one was just looking at the list before. Now they replace it with this. So if I want to find live cattle, there we go. And let's do, come on, April. We're going to go long, add to preview, and then feeder. Now I should also say, I should be looking up to see what the ratio is supposed to be, that I'm not doing the incorrect ratio here. But again, I can do April -1, add to preview, save and margin. And just a 1-to-1 ratio of live cattle versus feeder cattle now, the initial margin is $3,419. And there's the maintenance margin as well. So they have this new calculator that, again, I'll go into more detail with that in another session with you guys. But basically, we got those overnight rates. And back here, it did actually show me, oh yeah, I was supposed to be doing 2 feeder cattle, 3 live cattle for that ratio. So if I wanted to, I can go back and I can edit this position, edit live cattle, it's supposed to be 3, and then feeder cattle, edit. That should be -2. There we go. Close that. Live versus feeder, reports, view report, and it didn't take for some reason. So I have to go back and edit it or redo a new one, but it would tell me the correct margins for that. So again, you get those overnight margin rates, and you don't have to do the math for it anymore if you use that margin calculator as well. Okay. If you're using notional value, the way you figure out reward versus risk is very simple. You look at the chart. Again, if I'm using this value, market value, it's not so easy because I have to multiply by point values. But if I'm using a notional value chart like this one, corn versus soy, when it loads up right here, let's say hypothetically, I have a risk. Again, I'm just drawing random lines. I'm not trying to make sense of anything with particular numbers, but right there, If we're doing 737 to 837, okay, that's $100 or 100 points. So if I'm trying to make a 3-to-1 reward to risk, I need to make at least 3 times as much. So my target should be 300 points away. That's how you calculate it. Very simple. Again, I'll go into more detail on their margin requirements and risk rewards. But when you're trading spreads, overall, these work in any market conditions. It doesn't matter if the markets are crashing or rallying. You can even trade sideways markets. You get lower risk because you're both long and short, so you don't have directional risk. You're just simply trading the spread difference between the two related securities. You also have drawdown management. They're higher probability trades because we had that reversion to the mean. More often than not, you're going to go back to the average at some point. And I mentioned lower margin requirements means you can trade using less capital tied up. Drawdowns, obviously, there can be correlation failures. They don't always work. Yeah, it'd be great. I always say in technical analysis, everything works except for when it doesn't, because that's the way it goes. Sometimes it does, sometimes it doesn't. Commissions, you might have to pay extra commissions instead of doing just a singular trade. There's also some slippage that might occur because you're trying to get 2 separate trades together. It may take a little bit more to get that filled sometimes. And you have to understand leverage. Leverage is fun. It gives you additional buying power, but leverage can be very dangerous. It increases your risks. So you want to make sure you don't take unnecessary losses. So how do we trade this stuff? Again, we're going to go into more detail in our next session as well, specifically, but we can do bull spreads if we want to take upward trends in a security, or bear spreads in downward trends, because we'll use less money for the margin to be able to get in versus directional trading, but we take less profits. There's different relationships. We have what's called contango and backwardation. Contango is our normal situation where further out contracts, because they have more time, are usually more expensive. There's what's called backwardation where that gets thrown out. And we have what is called reversion to the mean. I've mentioned that multiple times. These are different ways of trading these. So again, I'm going to go into more detail in our next session that we get together about how this actually works. And you can even trade a raw commodity versus finished product, crude oil versus gasoline. They call those crack spreads. Or you have the crush spreads, where you have soybeans versus soy oil. So there's a lot of relationships that are out there you can trade. So again, I'm kind of running out of time here. We're going to go into more detail in our next session, but directional trading, if you expect a directional move, you can use a spread as a substitute and have some adverse price protection because you're both long and short. As I said before, these move in the same direction, different months, but not at the same pace. And there's opportunities there. All right, so I'm going to have to cut it short here. Again, we'll go ahead and finish the rest of this in our next session where we talk about practical uses. And I'm going to turn the floor back over and thank Jesus for having me.
Thank you, Brandon. It's always great to have you. The information is so very interesting. And the way that, I really like the way that the charts can be created, and all the different resources that are on the CME website to also help you calculate risk. Very interesting. For all the future lessons that are still pending, lessons 2 through 6, please make sure you visit our events page. And remember that you go to tradestation.com, go to learn, and then events, and you can see all the classes on this series that are upcoming right there on the calendar. So make sure that you register. We'll send you reminders the day before the event and also an hour before. So thank you, Brandon, again for your time and your expertise. Thank you, everyone, for being here. And I look forward to seeing you in one of our future classes. Goodbye, everyone. Great seeing you. Bye-bye.